Right, hi guys. So we're going to carry on talking about the ledgers. Let me just make some space and just get there. So talking about the ledgers really is where we're going to go now. And as I said earlier on, we have we've gone from the source documents to the subsidiary books, and that information gets fed, if you like, into the different ledgers. But my keen interest, my key focus right now is to focus, if you like, on, yes, my key focus is to focus on the general ledger. But the key point here is that we went from, if you remember, our source documents into the subsidiary books. Yes. The thing is, there are 6. That should be R. Yes, they are very good. There are 6 subsidiary books. Yes, and we discussed these in the last lecture, in the last video, so have a look at those. Now, I'm really interested, primarily, if you like, I am interested, yes, or I am into, if you like, 1 second, I need to see if I can get onto the next page, see if it's in that inserts space. I'm interested, if you like, in one of the ledgers, if you like, and that's the general ledger. Right. I mean, there are 3 ledgers. This is important, right? There are 3 ledgers. This is my first time using this thing. It's not working very well. I'm going to revert to the typical normal page. Right. There are 3 ledgers, if you like. So we have subsidiary books, and that comes into like 3 ledgers. Yes, if you like, we have the general ledger, the sales ledger, and the purchases ledger. Yes, I'll come back and talk about these later, right? But I'm not really interested in this. What I'm really interested in, what I'm trying to focus in on right now, is this one called the general ledger, or in other words, the totals ledger, right? Right, okay, before I do this, I'm going to balance some accounts from what you did in subsidiary books, and take that information from the subsidiary books into the general ledger, and then we're going to balance the T accounts in the general ledger. So the general ledger, if you like, is the first place we start discussing this idea of double entry. Okay, so this is very much the double entry that we played with earlier on, right at the beginning of the program, comes into play. What do we debit? What do we credit? Yes, this idea of dead click. Yes, and you can see this whole thing here. D just means debit, and E expenses, A for assets, D for drawings, C means credit, L liabilities, income, and capital. So whenever these things go up, we credit it. Whenever any of these go up, we debit. And of course, the opposite. Yes, remember, we've talked about this before. Okay, now, as I say, I'm focusing on number 3, the general ledger. We'll come back to these 2, but you can probably start to work things out as we go along. But the key point is I'm focusing on the general ledger, also known as the nominal ledger, also known as the totals ledger. Yeah, really important. Right, let me just skip all here. You see the generals ledger, the totals ledger, and this, if you like, contains, if you like, all the accounts. The key point that I'm really interested in really is the totals. Yes, the totals. That's what's really happening here. I'm interested in the totals. Right. Okay. So let's go back out and go back to what you prepared earlier. So last time you prepared this exercise, you prepared some T account and some subsidiary books for this, if you remember. Yes, and you prepared some subsidiary books for this. So I'm going to take you there, right? And you prepared. These are the subsidiary books for that thing, and I just nicely, neatly laid them out. You had a sales day book, and those were the individual amounts in there, and that's the total. Your sales day book for Whitney Houston and Elvis. That's your sales returns day book. That's the total. These are just subsidiary books. Purchase day book 5,000. Purchase returns day book 500, and that's your cash book. Yes. And those are the details. 10,000 coming in, 800 from customers. Sorry, from Whitney Houston, Elvis, 1,800. You paid out rent. You paid for shop fittings, and you also paid your suppliers. And you can see these are separate under suppliers and other customers and other. Just really just to be clearer on what the totals are, because that's what I'm really interested in for customers. Mixing everything in one heading might slightly confuse us, and I want to avoid that. So what we're going to do is we're going to work with these totals, yes, and we're going to take these totals, if you like. This is the first time we actually start applying the double entry principle with these totals, yes. So we take the total, for example, 3,000, the total of sales. That's the total of all your sales invoices. And here we are. Let's look at that. What we're basically saying is we have sold goods worth 3,000 on credit. What is the double entry representation of that? Well, the double entry representation of that is, yes, we have, if you like, let's look for the sales. Where are we? Let me see. I think sales is further down, or is that further up? Is that one of the first ones? Here we are, sales, right? So at the end of the month, when we close out, we say, well, we had sales of, I think a total came to 3,000. Following the accounting equation, whenever you have made sales on credit, well, I goes up, as well as your trade receivables. Yes, so of course you remember this. You remember very clearly that what's really happening here is, this is what we have. We have this D plus E plus A is equal to C plus L plus I. And what's happened here is that I has gone up, which is sales, as well as A, which is trade receivables. So trade receivable has gone up, and sales, this is I, by the way, letter I, and sales have also gone up. And we agree that when anything on this side of the equation goes up, yes, we credit it. And when anything on this side of the equation goes up, we debit it. Yes, you remember this. So what we do is we just go to our T accounts. Yes, in, if you like, the general ledger. All of this is in the general ledger because we're talking about totals. So I take the totals of trade receivables, that's the total, 3,000. And I credit sales. And then I go to trade receivables, and I debit that because, if you like, that's what's happened. That's gone up. Yes, you understand that. So I debit trade receivables, and I credit sales. All right, so let's look at the next one. Let's look at the next one. Oops, let's look at the next one over here. So the next one here is we have purchases daybook. We purchased material worth 5,000. Sorry, forgive if the noise in the background. I'm sure you can still hear me. So we purchased some material worth 5,000. So what do? You bought that material on credit. So what we have is, coming back to the T accounts, is that we have expenses going up by 5,000, but you also have a liability, which is a trade payable, of going up. So we have the expense of purchase going up, and we have the liability of trade payables also going up. So what do? What we do is, let's come back here. So if an expense of purchases goes up, we need to find the T account for purchases. Here we are. I already have it sort of semi-prepared. We have 5,000 there, and we have trade payables, 5,000 here. Debit purchases, credit trade payables. These are totals. They all live in the general ledger. Okay. The next one is we have the purchases daybook, for example. Let's deal with that. We have the let's look at the sales returns daybook. We have 200 pounds worth of goods were returned to us, right? So really what's happened here? Well, what's happened here is if these goods were returned to us, technically what we're really saying is, well, we're not owed as much. Trade receivables, has come down because they've returned goods to us. When we sold to them, we debited this and credited sales, right? Well, they've returned some goods to us. So really, technically, I has fallen, as has trade receivables, but by little, just by not a lot. So, of course, because this has fallen, well, we must debit I, and because this has fallen, we must credit trade receivables. But we don't go into I itself. We don't go into actual I. We create a new account called sales returns, remember? And so, let us go there to sales returns. So we go to sales returns, and we go to sales returns. Where is sales returns right now? Sales returns. Sales returns. Here we are, sales returns. So we have sales returns. So technically we have a fall in our sales returns, and what we have is trade receivables, and I believe it was for £200. And then what we also do is we go as well to trade receivables, because that's what we're fundamentally saying. We're fundamentally saying that we are no longer owed as much, if you like, by the people we're sold to. Yes? And then we also have a situation where we return some goods to Shoes Limited. So going back here, we go to purchases returns, exactly the same idea. Leave purchases alone. We will still see the two connect, but for now we debit purchases returns with 500, and we credit purchases returns. It looks like it over there. Very good. With 500. You can see the references. So you can see in purchases returns I write trade payable, so I know where to look for the opposite of this. It's just good referencing, so you know exactly where to go. You know what this is in relation to. And then who's next? Let's see what else we have there. Right, so I think we've done we've dealt with the main ideas. We've done sales, sales returns, purchases, and purchases daybook. You can see I've actually not even bothered with the general journal, just because it's a memo. But for my T accounting, I don't really use it. I use the information in all the other subsidiary books. It's just a memo. Capital. So this is really the total here. Total of in terms of capital is 10,000. So I make, I pretty much go to my bank and capital, which is all that's happened really. So I have capital 10,000. And then I have a capital account sitting here, 10,000. Yes, and yes, because again, I know I'm saying it over and over again, but it's important so we make sure we're all on the same page. When capital goes up, well, when anything on this side goes up, you can see here that C goes up. Yes, and A has also gone up. So credit C, debit bank. Yes, that's really all that's happened. Where was I? Let's go to the next one. We have here we have money received, if you like, from our trade receivables, and that comes to a total of those two together. You can see the total 2,600. Yes, I'll show you later on in terms of balancing these, but for now, just add them up together. It's 2,600. So that's the total that's come in from your credit, your customers, if you like, your 2,600. So we have 2,600. Yes, and that's your received. Oops, actually no, this was, I don't know, in my rush I've made a mistake here. We don't write their individual names. We just write. Let's just delete that. That's just trade receivables, because we are interested just in totals. Yes, 2,600. Yes, let's get rid of that. And then of course we go to trade receivables and we put that in. Yes, 31 Jan bank 2,600. Right. Finally, I think you have a trade payable because you paid some money, I believe. You paid some money. You paid some rent. Here we are. These are all totals on their own. Rent and shop fittings. Let's do those two together. Let's do those quickly. Rent. We'll do those at once. Let's see. Do we have a rent account somewhere? Rent. Here we are. Rent, this is an expense. Rent is going up, 500. And let's go to bank. 500. And let's go to shop fittings. Same for shop fittings, 31 January. Bank. You have an asset here, 1,500. And you credit bank as well. Shop fittings, 1,500. Right, and then I believe you also paid some money to Shoes Limited for 4,000, and that's your only trade payable in this case. So you have 31st of Jan. Trade payables, $4,000. And then therefore you know, you need to find your trade payables, because that's the double entry, right? Because you have a liability coming down and your bank asset also coming down. Yes, 31st of Jan. Bank, 4,000. I mean, you can see the logic here. You can just see it. I mean, this is the important thing. Above everything, you need to see the logic. You bought some goods worth 5,000. You owe these people. This is a liability. You owe 5,000. It's showing on this side. You return 500, reducing your liability, bringing it down to 4,500, and you pay off 4,000 of that liability. It's simple language. So, and that's pretty much it. I think that was the last thing. And the next step, if you like, is to balance these accounts. I'm going to balance one or two, and then you finish the rest. Let me balance an obvious one. So what do we do here? In terms of balancing, which we've talked about, you compare both sides. Credit side with the debit side. You compare, you find out the difference between both sides. The difference between both sides, if you like, is 500. Yes? I think I'm going to use a different color. I think I can find a different color. Yeah, I think so. I think this might be a different color. This might give me a different... I use a red pen. Oh no, that's not a different color. Excellent. So what do we have here? So what I do is I put the difference. Oops. I put the difference. That difference between both sides. That difference between... I'll change the color after. That difference between the left side and the right side. I put the difference on the smaller side. And I call that balance carried down. Right? And that difference is 500. That's what the difference is right now. Isn't it? That's the difference. That's the difference. Yes. The difference between this and this. And then what we now do is we add both sides up. You get 5,000. And you get 5,000 here. I mean, you know, you can make this black again if you like. And that's it. You're balanced. And what we do is we underline these, if you like, with this type of top and bottom. See, it's actually stored in Excel because it's very common in accounting. And that's how we balance. And then what we do is we bring this over to this side to say, basically, in the new year, I'll change the colors later, on the 1st of February, yes, we call this balance brought down, 500. I'll change this color again and make this red. So what are we saying fundamentally? We are saying that on the 1st of February, you are still owing £500, which is true. You can see it. You bought some goods with 500, you haven't paid. You return £500, you pay 400, so you're still owing 500. This is just the accounting way of depicting or showing this information. That's all. So that's an example of a balance carried down. Let's do one that typically has nothing on the other side, which is nothing different. Basically, you compare both sides. This is the smaller side. So what do we have? We have the 31st of January. Balance carried down. Yes, and then we write that, 500. Let's just change the color. And then what do we do? Well, just add everything up. 500. 500. There you are. And there you are. Yes. And then if you like, you now have your, on the 1st of February, you have your balance brought down, and you have your 500. So just create insert. Yeah, and look at that. That's what you have. Yes, I mean, I think I'll just make a line here as well, just to yes, and so that's how we do this. And what we're interested when it comes to going to the trial balance, which I'll talk about later on in a second, is that what we're really interested in is taking all these balances brought down. All the balances brought down, is these are what we're interested in taking on, if you like, to the what's referred to as the trial balance, which I'll make in the next video. But the important thing here is this. I want you to go on ahead and now balance off all these other accounts, if you like, on your own. When I make the trial balance video, you'll see the answers. But what I want you to do is go along and, you know, balance all of these and prepare, if you like, your go ahead, we've done this before, your trial balance, but I'm more interested in you balancing these off. You know, let's just do one more. Let's do this trade receivable one. Look at both, compare both sides. What's the smaller side? Well, this is the smaller side, 2,800. So find the difference and put the difference in here. 31st of January. Balance carry. It's a video. You can watch this over and over again. 200. That's the difference between both sides. Yes, you can use a different color if that helps you. Then just add them. You have 3,000 here, which is what this is. Of course, you're adding this downwards, and you're adding this downwards as well. And this downwards as well. You can use the Excel button. That's 3,000. Use the top and bottom, and then you have the balance carried down coming down to the other side on the 1st of February, basically saying this is the balance brought down, and this is 200 over here. Yes, and let's put that in red as well. So there we go. Yes, so basically what are we saying here? You sold some goods on credit. You are owed 3,000, right? Because that's what this is saying. Debit this asset. This was returned to you, 200. Then you received 2,600, meaning you're still being owed 200. And this is how we deal with it. We do a difference between both sides, carry down, find that difference. So technically, the 1st of February, we know we are still owed £200 into the new period. And that's how we start. Okay, great stuff. So finish, the rest, because this video, this has really come from the, what's the word? This has come from this. Yes. So, pause it, get all this information down, draw up the trial balance just to be sure, and in the next video, you'll see what the trial balance finally looks like. All right, great stuff. Good luck. See you in the next video.